Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts. Mark and Phil back again to talk about bonds. Not James Bond, unfortunately.
Not James Bond, no.
Yeah, he's pretty cool.
007.
Yeah, this is 00 bonds.
00 bonds, yeah.
Is that a rating for bonds, I wonder? Anyway, how
no,
bonds
usually
work?
It has the ABC, you know.
ABCs of bonds. Hey, that could be a good title.
Good title, yep.
Yeah, the ABC of bonds. We're going to get into this, Phil, because bonds right now are interesting, to say the least.
They're throwing people for a loop.
And I'm just going to jump right in since we're already kind of getting going here. Sure. It's one of those things where typically, right, when we have bad markets, which we're clearly having, that the traditional ways of thinking are let's go to bonds, right?
Right.
And that's what we think about when we get older. It's what we think about when we have bad markets. But right now, it's a little wonky in that arena.
Yeah, it's not the safe, secure investment that everyone thinks of it as usually.
Yeah. So let's start at a base level. Just kind of basically, why do we see so much misunderstanding around bonds on how they work? Can you give us just a quick overview on them?
Yeah. So really, what is a bond? I mean, when you invest in a company, there's two ways to invest. You can either own it or you can borrow or lend to it.
You're loaning the money. Yeah.
The lender of to that company. So you don't really own anything in it, but they owe you money.
Yeah.
So stocks, equities, that's the ownership. Bonds is you're lending effectively the company that money. Now, you didn't lend them the money. You're buying into a bond, either physically buying a bond and you can buy them in series, or you can buy a bond fund. So there's a lot of ways to get into a bond from a company, but that's really what they are, is how you have ownership or interest in that company. From the reason they're thought to be more secure from what you call a capital stack, if you want to think of it that way. If things go really bad in a company, well, who gets paid? The secured creditors on the top, and bonds are usually below that. They're not secured. They're backed by the general claims paying ability of the company.
Right.
At the bottom of that capital stack is the stock, right? So the equity. Right. So, if things go really bad, all these people get paid and you're at the bottom, you might get something, maybe nothing.
Right.
But that's why the security comes in. On the flip side, though, it works the opposite way. If things are really good, you as a bond owner, all you're going to get is what the interest was and the principal back, right? Yeah. So you're not going to, if the company's done phenomenal, here's your interest, Right. So, that's the advantage to the equity is the company does good. Well, you're going to participate in that probably because the stock prices rise. That's the yin and the yang, so to speak, of how do you invest.
And hence the conversation of moving to bonds more as we age for safety, right?
Right,
that's, again, the traditional idea.
So that's kind of at a high level, exactly. The traditional thought of, so it makes sense. I want to move more towards bonds.
Yeah. Okay. So you mentioned funds. So real fast, what's the difference between a bond fund and an individual bond? It should be fairly self-explanatory, but let's go ahead and explain.
Right. So at the end of the day, you both have owned bonds, right? At the end, you have underlying bonds, but it's no different than, the difference between buying a stock fund or buying the individual stock in a company. The main difference is in an individual bond, you control when that bond gets sold or bought, right? So you're buying the bond, and as long as you buy a bond, hold it to maturity, and the company's still around, it's credit worthy and can pay the bond back, then it can be a secure investment, right? Because you're going to get whatever the interest is. If it matures and the company's still able to pay it, it's going to pay you back the principal. Everything's good. So from an individual bond standpoint, you have that security, not dealing with market fluctuations. Now during now to when the bond matures, the value might go up and down.
Right.
So the difference in a bond fund, though, is that, the bond fund does own individual bonds, but unfortunately, you don't get to control when they buy and sell. And the manager doesn't necessarily control it either.
Yeah.
Because what's controlling it is inflows and outflows from this fund.
As you mentioned before, it's a collective pool.
Right. It's a pooled investment.
Yeah. And if somebody, has an issue in the pool, everybody gets affected, so to speak.
Yeah.
Right?
We should probably do a whole show on mutual funds because personally, I'm not a fan of funds, mutual funds. there's pros and cons to them.
We can do it
for somebody with a smaller amount to invest and wanting broader exposure. They're a great vehicle.
Sure.
The disadvantage is, to your point, it's a pool investment, and what somebody does in the pool affects everyone, and it can have severe negative effects in markets like this because that manager of the fund is dealing with money coming in and out. So if money's coming out of a fund, they don't have a choice. They have to sell underlying investments to pay that redemption at the end of the day, even though it might not be the right time to do that.
Let's talk about the fact of the interest rates, first of all. So how bonds work with interest rates, Phil, the best way that I was always taught it to remember is that when rates are high, bonds die.
Yeah.
And when rates are low, bonds grow. So it's a kind of a little, rhyming thing.
Yeah. Or I think of it like a teeter-totter, right? You know, so interest rates are high, that same concept, right? So as rates rise, and if you think of it over time, right, what have interest rates done over the last 20 years?
For 40 years, Phil, they've been pretty low and then pretty stagnant, right?
Well, and they've dropped. So you think of the last time we went through a major market correction, 2008.
Okay.
Interest rates were higher at the beginning of that downturn in a market.
Right.
And they started to decrease over time. And a lot of times that'll be part of the Federal Reserve.
That's their strategy to fix
their strategy to help boost the economy is they'll lower interest rates to encourage borrowing, encourage spending, and get the economy boosted again.
But now we're in this whammy of they're having to tick it up for inflation, yet the markets are also crapping out too. So
so this has been, both of those colliding at the wrong time. So the last time this happened, interest rates were falling, bond values were going up.
Yeah.
In the way I always explain it to a client is if you think of it this way, if I own a bond today, I invested in a company and my bond is paying 4%, right? And interest rates are falling. So now the company is issuing new bonds and it's only paying 3%.
Hey,
you want to invest in that company, you can buy my bond and get 4.
Yeah.
Or you can go get a new bond from the company, but they're only going to give you 3.
Right.
Well, if that's the case, I'm not going to sell you my bond at face value because it's worth more because you're getting 4% on it.
Yeah.
So mathematically, I'm going to have an increase in value in my bond.
Yeah. Well, we're seeing the opposite right now.
I was going to say, if you think of that relationship, just the opposite starting to happen today, right? So we've had this decline in interest rates, bounced around at the bottom for several years now, and now things are increasing. Well, just the opposite happens, right? If I have the bond now at 3%, now the company's having to issue bonds at 4%.
Yeah.
Well, you're not going to give me face value for my bond. You're going to pay me something less.
Yeah.
And that's that inverse relationship of as interest rates rise, the bonds die, or think of it that teeter-totter, rates are going up, values are going down.
Yeah. The $64,000 question today in October, late October or mid-October of 2022 is people still consider them to be a safe approach as they're getting close to retirement. Is it in this current environment?
Well, so individual bonds are definitely safer in that you control it, right? So it's the downside to an individual bond is to build an effective portfolio. It's a lot harder. You got to have a substantial amount of money because you got to ladder these bonds out.
Right.
And the only way you're going to get the advantage of not being affected by this, teeter-totter effect is being able to hold out and ladder these and wait till bonds mature. So if you're thinking it that way, when I'm going to use it, I have to have a substantial amount of money to ladder my funds out to let it mature over time. And at the end of the day, they're still not paying as much as inflation, right?
Right.
I mean, bonds are paying 4 or 5% maybe today. Inflation's 8%, so you're never going to keep up with inflation with a bond. Is it safer now?
Yeah.
I mean, it's safer at this point than it was in January, unfortunately.
Okay.
So looking at the markets, and this is the reality of where they're at today. I was just looking at bonds right now. The bond market as a whole is down almost 15% from January
for the year, right?
For the year. So January till what is it? October the 11th today.
And I don't think that's happened. And if I just saw the other day in a very long time.
Yeah, I mean, exactly. The last time we've had this kind of an increase in interest rates so quick. Putting in a perspective, the Dow is down almost 20, S&P is down about 25, NASDAQ's down almost 34.
As of today, when we're taping this.
As of today, right. So it's, what is a safe investment? Okay. In perspective, compared to all the others, it's still safer.
Yeah. Yeah. If the markets are down 20-25, bonds are down 14-15. Yeah. Technically. Yeah.
Yeah. But I mean, somebody going into a bond investment being down 15 is probably not what you had in mind when you put money in bonds.
Yeah. Yeah.
So, it's a real predicament right now.
We're in a quandary for sure.
Right. And I think you have to look at some alternative potentialities to bonds. And there's a lot of things that have been out there for a while that are starting to become more appealing, maybe as an alternative to a bond.
Yeah, and maybe we should do the next week shows on these some of the things that are going on, because I was just going to ask you that, and we'll wrap up here in just a second. But obviously, we're seeing a bigger push. I'm seeing a lot of marketing here right now for annuities. When things get to like they are right now, those annuity sales come out like heavy duty. And again, there's nothing wrong with an annuity as a product, as a vehicle. How it's used, how it's explained, and for the right scenario, I think becomes the interesting part of the conversation, because what happens is now everybody, right? The old adage is everybody is nervous. So everybody looks like a nail, and I got this hammer. So let me just go, right?
And it's the only thing in my bag. So it's
the only thing in my bag, or it's the best option in my bag right now. So let me just push that one. And again, it could be a useful tool.
Absolutely.
But there's a lot happening right now. So I think, to me, more than anything, a strategy and a plan more than ever right now should be on the radar, right? Because we are some of all the traditional moves, they're not quite working right now, Phil, because everything is so wonky. So I guess my takeaway today, Phil, for our listeners would be, if the traditional idea, if you're worried about the stock market right now, and that traditional idea is pinging around your head, let me move to bonds because it's safer. Technically, those numbers kind of say it still sort of is, but it's definitely worth, I think, having the conversation with your professional or getting a professional. Don't just jump to bonds because you think that's what you've heard for the last 35 years.
Right. Now, I mean, the piece of bonds that we haven't built into this and isn't explained in the downside of the 15% we just talked about is bonds do pay interest, right? So I mean, that helps offset some of that.
True.
But it's still your
dividend paying bonds
value,
still
right?
Strategy.
Bonds all pay interest, right? So I mean, you have that component that is going to vary depending on the type of bond you get in, and whether it's a junk bond, quote unquote, the high interest rate bonds, and that gets a whole nother discussion of types of bonds. But so it's not something. Don't just throw it out and say, oh, it doesn't work anymore. Like we've talked many, many times with all these different strategies, the worst thing you can do is panic and do something irrational just because I don't know what to do. Let's get out, have a plan, understand this is how it works. Talk to somebody. Exactly. Before you just jump in and,
there's a lot of
strategy that might not make sense. So
I'll leave with this kind of, interesting. I don't know if this is a good analogy, but I'm going to go with it. So, in Michigan, there's lots of lakes, right? There's lakes everywhere, lots of fishing going on. And the same thing here in the South, right? And so there's this, the hillbilly hand fishing. Are you familiar with that? Have you ever tried it?
Nope. Is that where they go down to the hole and grab?
You stick your arm in a catfish hole, right? Yep. You stick your arm in a catfish hole and it bites. You pull it out.
I was going to say,
I haven't done it. I'll never do it. However, a funny line from a movie, but it works well, is like, if you just, if you're drunk, maybe you're just hoping for the best. But people that actually do this because they know what they're doing, they have a plan. They don't just stick their arm in there.
Right.
They have a bit of a strategy. They have a bit of a plan. And I think that's the same way you could, if it's a funny little way of looking at it. But right now we got to have a strategy, right? There's so much unknowns happening. And you don't know what that catfish is going to do, right? So
right.
Make sure that you have a plan so that you don't come away with a bigger bite than you need to, so to speak. Is that a cheesy analogy, but it works?
No, that works. That works. I was going to say, the short-term reactions that you have long-term results, right? So think of it that way. It's might feel really good today. So I'm done. I'm out. But okay, what was the long-term effect of that? Maybe it would have been better to ride through. Maybe one of the things with bonds that a lot of managers, depending again on the strategy of the fund, they might move short term, right? So the shorter the term of the bond, the less volatile it becomes because there's not as much exposure.
Okay.
If you have a bond that's 10 years till maturity, it's going to have a deeper effect to this kind of a downturn in a market as interest rates rise, because there's a long time before that bond matures.
Yeah.
So there's a lot more risk in that. If it's only 12 months, well, it's probably going to go down, but it's not much because they know that clock's going to reset in 12 months and you get to invest in the higher bond, higher paying interest bond. So, I mean, that's one strategy that you'll see in this is terms are starting to get reduced. But again, to your point, you can't sell all the long-term and go to short-term because there's only so many short-term bonds out there.
Right. Very true. Very true.
And the more the people that sell the long-term, the deeper the fall there. So, I mean, it's a catch-22.
Yeah, so. Exactly. So you got to have a strategy. And now more than ever, again, there's a lot of stuff going on. So if bonds are on your radar or having a conversation around them, make sure you're talking with a qualified pro. Reach out to Phil. Obviously, if you don't have one, or even if you do have one, but you just want a second opinion on the strategy, give Phil a jingle, stop by the website, whatever you need to do. Subscribe to the podcast. We certainly love having you. We've been doing these. We were well over 100 episodes. For sure. So come on over and hang out with us as we chat about all sorts of crazy things, but hopefully share some useful nuggets of information with you when it comes to getting ready and getting to and through retirement here on Phil's Tax Hacks and Other Retirement Facts. Stop by the website, philstaxhacks.com. That's philstaxhacks.com, or call 248-888-7530. It's 248-888-7530. Numbers on the screen if you're watching. Phil, my friend, thanks for hanging out. I'll see you soon.
Good week.
We'll see you next time here on Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.